Hello, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and we have a very interesting closing bell today with Gary Kamen of barchart.com. He's a 25-year veteran of the markets, and he's also Chief Market Strategist at CRB's Trends in Futures. And his presentation today is called Mastering Market Direction and Making It Work in Your Favor. So he's going to be basically answering the questions of what moves a market, and more importantly, who is moving the market. And he's going to be showing you numerous different explanations and topics, including the chart indicator you should be using to uncover what truly lies beneath a market's direction trend, as well as a simple strategy to find high probability trades that he's perfected over nearly 2 decades. And they work in all market conditions, up, down, or sideways, as well as a unique trend following system that produces buy and sell signals. So I always enjoy these presentations that our closing bell partners give us, so definitely be watching that with great interest. But for now, I'm going to be doing my market update and analysis, so bear with me one moment. Here's the S&P 500. We had a little bit of a mixed day, mostly because there was some mixed news that came in. Mostly earnings have been driving this market. Earnings have been coming in a little bit light, a little bit lackluster, kind of disappointing the market, partly because of the oil bust. A lot of energy companies have been hit pretty hard. Also, the rising U.S. dollar has been hurting exporters. But today we saw the market pull back a little bit early on in the session and then recovered toward the end. So let me start drawing my lines. One second. So I've been watching this 2040 support level in the S&P 500 for quite some time, for at least over a month actually. And I'm also watching this resistance at 2120, which is the prior highs that we saw back in late February. So looks like it's just still in a range, just bouncing around back and forth. It's very possible that this range is also taking the shape of a wedge pattern. We saw a similar pattern back here, back this past fall and early winter. So I'm not seeing any real decisive trend until one of these levels is broken. But you'll notice, for those of you who took my candlestick workshop back on Friday, you'll notice that this is possibly a hanging man pattern. So it could be a bearish pattern, assuming there's a bearish confirmation, meaning a solid red close, a solid red day on high volume. If so, then there's a chance that we could see the S&P 500 return back down to its support level back at 2040 and try to retest. On the other hand, if it just surges and breaks above, then the next level I'm watching is that resistance level. So just keep your eyes on that candle. It seems pretty interesting and notable. Let's take a look at the Dow. You can see it makes very similar moves. I'm not going to go into all the details. It's very similar to the S&P 500. Similar wedge, possible hanging man pattern. I'm also looking at this key level at 18,000. Should be important psychologically. So right now I just want to see, is it going to really bump its head at this downtrend line, which is a resistance, and maybe try to retest the lows at 17,600, or if it can experience a solid breakout. So for now, it's just range bound. See the tech-heavy NASDAQ 100. Pretty much the same thing. You can see 4,300 is the support. Looks like it's in a little bit of a wedge type of pattern. What's interesting over here from a candlestick perspective, this looks like yesterday's session formed a shooting star pattern, which is typically a bearish pattern, assuming it's confirmed. And then today's session formed a hanging man. So that's interesting when you see this clustering of candlestick chart patterns like this. It usually tends to have more significance, but really it needs a solid confirmation in the form of a red down day, basically a day that closes down on high volume, and then if so, could try to retest its lows. If not, it'll try to break above. If it goes above, I consider nibbling on the long side here. Let's look at the Nikkei, Japan Stock Index. You can see it's for months it keeps on rising in this channel bouncing back and forth. Everyone in the cyber group who's been following me has been following this channel. And you can see right over here, this was a hammer pattern, bullish chart, candlestick chart pattern. And then we saw another hanging man. Actually, I think this is on Friday. So, and then you got this bearish confirmation. So now, of course, it's selling off. I just basically just watching to see if it's going to try to retest the lower bounds of this channel. This is a support line at the lower bounds of this channel. Also, it's just occurring right around 20,000 in the Nikkei. So that's a key psychological level. And I always watch those major round numbers and levels in all the markets that I watch. Let's take a look at the dollar. You can see here's where it's getting very interesting now in the dollar. Similar to the Nikkei, I've been watching this channel. It's still in a confirmed uptrend just because it's been in this channel. It's above this rising uptrend line, which is a support. But it tried to break. This is the U.S. dollar index, by the way. It yesterday tried to break above its prior high that it reached in mid-March. Was unable to do it. Formed a shooting star pattern, which we discussed yesterday, saying that that's typically a bearish pattern. And what do you know? You get a down day. It's really not too surprising. It's basically rejecting the prior highs. It doesn't mean that a downtrend's about to begin, because nothing's been confirmed, but I want to see if basically how it acts from here. Is it going to try to maybe gun for its old highs and finally break above and then continue rallying? Or is it going to break this long established uptrend line and experience a technical breakdown and then try to reach this other support, which is basically the highs that it saw back in January, February? You can see that was a support right over here. It kept on trying to fall, bounce off, bounce off, bounce off. So if it can break there, then I would say the downtrend has started. So the dollar has very strong implications for commodities and non-U.S. currencies, which is why I place such a high emphasis on following the U.S. dollar index and analyzing it as part of intermarket analysis for commodities and other markets. So I think no trading system, I don't think any trading system should be without an analysis of the dollar. Also the euro, really quickly, just basically the inverse version of the U.S. dollar index. Sorry, you know what, I didn't mean to draw that. You can see it was bumping its head right at 1.11 to the U.S. dollar and also 1.1. You can see lots of tall candle wicks here, meaning it kept on trying to break above 1.1, was unable to do it, and then sold off. And then I was saying that once it really rejected that level, that it's likely to try to gun for its old lows around 1.05. Well, that's exactly what happened. It tried to reach its old low, which should be a support, and was unable to break them so far, and it bounced. So now I want to see if it's going to bounce back. But basically now it's just in a range between 1.05 and 1.1. So it's going to probably bounce around for a bit until the market finds its direction, and then the next directional move will occur. All right, let's look at the dollar-yen. Still in that range. Basically a longer-term consolidation or wedge. I'm just watching for one of these levels to be broken to signal the next directional move. I'm still not seeing any real confirmation either way, but of course we saw this long upper wick on this candle, so it's not surprising that today's a down day. But really, one of these levels need to be broken for me to see a real confirmation of the next trend. Let's look at the dollar Canadian. Same thing, same pattern. You can see it's basically consolidating, similar to how the U.S. dollar index is, because the dollar Canadian is correlated with the U.S. dollar index. You can see the dollar is down today, and Canadian dollar is up because oil rose, and Canadian dollar is correlated with oil, so that's why the dollar Canadian pair is down. And what's interesting is that we all discussed yesterday in my cyber group update that there were these shooting star patterns. There were two in a row in the dollar Canadian, and that's typically a bearish sign. And there was another one up here. So, of course, we get a big down day. So it's interesting to see this all working in real time. But still, similar to the other pairs, I want to see this consolidation broken one way or another, and that has not yet occurred. I'm going to take a look at oil now, just because it's important for anyone who's following the Canadian dollar. and also just many traders trade oil stocks. Many people in Cyber Group today were trading oil stocks, so this is pretty important as well for them. You can see I've been showing for a while that West Texas Intermediate crude oil has been trading in this range between $54 per barrel and $44, and just bouncing back and forth for months and months, going all the way back to early January, really. So you can see it rejected that $54 level several times. It's trying to shoot for it again. I don't know which way it's going to break, and I'm not even going to try to predict. I just react. If it bumps its head here, it could maybe try to retest the lows. I know there's a huge oil glut out there. In all reality, oil should not, according to logic, oil should not be rising. It should be dropping just because the glut is getting larger and larger. But of course, there are other factors that are at work involved in the market, so that's why I just follow the trend itself and not what the market should do. But I'm skeptical. I don't see the fundamental conditions as being this gung-ho case for this oil rebound. Really, I mean, I'm not seeing massive bearishness across the market among market participants. Haven't seen a real capitulation sell-off in oil. So I still think that there are downside risks from a fundamental perspective, but if it rises above 54, let's put it this way, I do not want to be shorting. I'd probably have a bullish bias against my better judgment. Just trade with the trend, basically. That's the idea here. And the Canadian dollar is correlated with oil. That's one of the reasons why I want to show you this. All right, let's see what else we have here. Let's look at the British pound really quickly. See, the British pound tried to break down from that pennant. Looks like this was a little bit of a retracement right now, partly because the U.S. dollar fell. So I would not become truly bearish on non-U.S. currencies until there's a confirmed breakout in the dollar, if it happens at all. However, if the U.S. dollar index breaks down, like I discussed earlier, then basically you're going to see all commodities and non-U.S. currencies surge because they trade inversely. So I would certainly consider going long if the U.S. dollar index experienced a real pullback. That could definitely be an interesting and very violent trade, very volatile, but that's what makes very good trends too. All right, let's take a look at gold. I know a lot of people in this room are gold bugs, including myself. I'm interested in gold. You can see gold basically last month broke out of this channel. And then gold also rebounded right off this 1150 low, this support level, which is the prior low that we saw back in November. It got a nice little bounce, but then I was showing these upper wicks. I said, uh-oh, this looks like gold is rejecting a certain price level over here. It goes up, comes down, goes up, comes down. And then now it's really starting to break down. It's really rejecting that 1200 psychological level. So today, bit of a down day, but I usually want to see the U.S. dollar index confirm what's happening in gold. For example, if the U.S. dollar index is really breaking out of that consolidation I showed, a consolidation, like let's say it broke the recent highs, then I would expect gold to try to retest the lows back at 1150 and maybe even break below and keep going lower. On the other hand, if the U.S. dollar index experiences its own breakdown, then gold's probably going to try to gun back for 1300 and maybe even higher. So should be very interesting. All right, folks, do you have any other markets you'd like to take a look? I know there are so many markets. I try to cater and show the most common markets. But if there are any specific markets or stocks or commodities that you want to take a look, I'm glad to give you my cursory chart analysis on that. I know we had a lot of people. ES Mini. Gad. Well, you know what? ES Mini is really just very similar to the S&P 500 that we looked at when I started. It just trades identically. Even though this is the S&P 500 trades lockstep with ES. So that's basically what I was saying is I'm looking at it's basically in a wedge. It's in a consolidation. So I'm not seeing any real trade setups until one of these are broken. But I was saying just within the context of this consolidation, there's a chance it could drop back down to the lows. Just assuming it rejects this level and can't break above, it may try to retest these lows. That's what I'm watching. Sorry. I was saying about the dollar yen. I was saying it's still trading within this wedge. It's in this consolidation. And that big moves oftentimes happen when a market breaks out of consolidation. So I'm watching for that next big move, whether it's to the upside or to the downside. But really, there's no clear signal being given just yet. All right, you want to take a look at Apple? All right, let's take a look at Apple. A lot of people want to look at Apple quite often. 1 second, let me just find that. Just pulling up another charting service just because the one I'm using right now doesn't really show stocks. Okay. Here we go. All right. Let me get situated here really quickly. All right. Apple. Okay. So here's Apple. And you can see Apple has been in a consolidation right over here. So I'm interested in which way this is going to break out or break down. I think when it does, it's going to make a sharp move, but I don't know which way it's going to be just yet. Let me just show you what else I'm looking at. 200-day moving average. I like to look at the slope of the 200-day moving average to tell me which way the trend is moving, just so typically there's a bias in that direction. So right now, trend is up, but it's a little bit overextended beyond basically above that 200-day moving average, and according to other overbought, oversold indicators. So I would prefer to get into a consolidation, let's say from a long perspective, when it's a little bit closer to the 200-day moving average, meaning it's not as overextended. So I just want to see which way it's going to break out or break down. If it goes up to the upside, then sure, I would consider a long on that. All right, let's look at the DAX, Germany Stock Index. You can see, I think I discussed this a few days ago. There was a consolidation period right over here, and the second it broke out, that was basically the long signal. When it broke right above 12,200, it just cleared a new high. It was a consolidation similar to what we saw over here. I wouldn't be buying at these levels just because I'd like to buy it just when it breaks out of consolidation, not after it's already made a big move, because now you're vulnerable to a pullback. All right, let's look at the Shanghai Index, or the SHCOMP, Shanghai Composite, as they say. I mean, this is just really, it's very extended. You can see there was a nice consolidation right over here. And the second it broke 3,400, that was the signal to buy. Trend was up. I would not, I mean, not that most Americans can even trade this anyway, because it's really restricted to us, but for some sophisticated investors, there's some ETFs that trade in Hong Kong, believe it or not, that track Shanghai's A-shares index, which is what this stock index is. I've done it before, but you can see this is definitely a bubble. There's no doubt in my mind. I'm not saying it's going to pop tomorrow, and this could probably keep going even higher, because that's what bubbles do, but I am very skeptical of the trend behind this. It's a lot of amateurs who are opening up margin accounts. High schoolers, college students are borrowing money to buy into the Shanghai Stock Index. It's basically the Chinese market. There's no way that's going to end well. And this is all driven by central bank, or this is mostly driven by all forms of loose money in China. There's just so much money just sloshing around there because of loose monetary policy. So I don't see how this is going to end well at all. But, you know, it certainly could make for good trading, but even though most Americans don't have access to it. All right, so the presentation will start in about 9 minutes, but if you want to discuss more trading with me, send me an email, jesse@c2trading.com. And I'm basically booking for coaching now. Coaching has become very successful at Cyber Trading University, so we're expanding more into that. And I'm doing a lot of coaching for a wide variety of types of trading, from everything from swing trading to futures trading to options to Forex to investing, finance, you name it, you know. And I have a lot of systems and a lot of techniques that you will be very impressed by once we actually start coaching. So shoot me an email and we can discuss it further. And Gary will begin in about 8-9 minutes, and I'll introduce him. So, all right, folks, talk to you shortly. Bye.
Testing.
Good afternoon, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited that we have this wonderful closing bell webinar with Gary Kamen of barchart.com, and it's called Mastering Market Direction and Making It Work in Your Favor. And he's going to be addressing what moves a market, and more importantly, who is moving the market. And Gary is a 25-plus year veteran of the markets and also Chief Market Strategist at CRB's Trends in Futures. And he's going to cover many different topics, including the chart indicator you should be using to uncover what truly lies beneath the market's direction and trend, as well as a simple strategy to find high probability trades that Gary's used for over 18 years and it works in all market conditions, whether it's up, down, or sideways. And he's going to be showing a unique trend following system that produces buy and sell signals. So I'm looking forward to it as usual. So Gary, thank you so much for coming on. And we have your PowerPoint loaded.
Thank you, Jesse.
Mm-hmm.
Okay, yeah, I just want to thank you, Jesse, for that great introduction, and thank you for inviting me today to present.
Our pleasure.
Also, I want to thank everyone for joining me today here. And everyone can see the Mastering Market Direction and Profiting from It first page, correct? Okay. Now, before I begin, I just want to tell you a little bit about me. My love of the market started on the trading floors of the Chicago Board in the 80s. Back then, it was the most energizing place I ever experienced. Today, the floors are gone. But keep in mind, the Chicago Board of Trade was established in 1848. The floor was around much longer than computers at this time. Now, in 1997, I went to work for Merrill Oster of Futures Magazine to manage Futures Learning Center. At that time, Futures Learning Center was the premier destination for people to come and learn how to trade. It was also the place every self-proclaimed market guru came to market their stuff. CRB bought Futures Learning Center in 2006, and I started Trends in Futures in 2011. And I've been managing my own account since 1988. And yes, back then I used to call a broker, but not today. So let's begin. Mastering market direction, and most importantly, profiting from it. For me, I look at 3 W's to successful trading. And what are those 3 W's? Those 3 W's are why, what, and when. And many people look at me and say, what do you mean why? Why do markets move, whether they're futures and even the S&P or corn or crude oil, or you're trading Forex? Why do Forex markets move? Why are these markets moving? What is moving these markets? That's different than why. What is moving the market? And of course, the most important thing, maybe, is when. When do you get into the market? And when do you get out and pocket money? So the first item we're going to look at is why. And many people have a problem with why. Fundamentals. Lately, actually over the past 10 years, fundamentals seem to have become a 4-letter word in the markets, and I don't know why. Fundamentals are why markets move. They really dictate when a market will move. But you can't ignore fundamentals because they will dictate what direction the market will move when it does. And again, I don't care if it's the E-mini S&P, T-bonds, the US dollar, the euro, any of the grains, the meats, anything. That someone's asking me about my last name. It's Kamen. That's a long A, K-A-M-E-N. So fundamentals are anything from Janet Yellen speaking, a Fed meeting, anything we're going through today with rates. People are talking about when is the Fed going to raise rates? June, September, 2016. That information moves the markets. Any of the Fed heads speak on a daily basis. Those guys can move the markets on what they're talking about with raising rates. And this is deja vu. Why is this deja vu? How many of you remember? How many of you remember when we actually had the QE3 tapering issue? Was Ben Bernanke going to taper sooner or later? And this is back when we saw good news becoming bad news and bad news becoming good news. And what was even more, back then was Ben Bernanke going to start QE3 tapering before he leaves? These were questions that had to be answered. But once we saw QE3 start tapering, what actually happened in the markets? Nothing major took place. It's the idea of not knowing when this takes place creates more volatility in the markets than when it actually takes place. And in fundamentals, we have everything from grain reports to reports on weather in South America to China. Information from China that came out over the weekend about their manufacturing and their exports. These are issues that can cause markets to move. But that's why the markets move. Now we're going to cover what moves the markets. Now when I go back and think about being on the floor, when a report would come out, say at 9:30, and a pit would start getting really loud and crazy, you knew the market was moving. For that split second, you didn't know what direction the market was moving in, but you knew the market was moving. And that's what we're looking at now. What moves the markets? And this is the bottom line in any market. What moves the markets is buyers and sellers. That's it. If the buyers and sellers aren't doing what they're supposed to do, the markets aren't going to move. And I've seen that on the floor for years. And more importantly, when I used to be on the floor, I used to watch markets very closely. And what was interesting to me was when a market was going up, who's selling in the pit? What trader in there is actually selling as the market's going up? And I knew these were institutions, and what they were doing was different than speculators. So in futures, just like stocks, for measuring buyers and sellers, we have volume. In volume, we have the total amount of contracts, just like we have the total amount of shares in stocks, long or short, traded for that day. However, unlike stocks, we have open interest in futures. And what's open interest? Open interest is the total numbers of contracts, long and short. There's the other word that's different there. Volume is long or short. Open interest is long and short that are entered for that day. For an open interest to go up 1 point, you need a long entry and a short entry at the same time. For it to drop, you need to see a long and short exit. And today, in today's markets, large commercial and financial institutions make up 70 to 80% of open interest. And that's in all markets. You look at the E-mini S&P, you look at T-bonds. I don't care what market you're looking at, they make up 70 to 80% of open interest. And yes, Mark, it's crazy, but it's true. Let's have a look at that. How big? And we're talking now dollars and cents. And I'm only looking at one side of these large commercial traders or institutions. I'm looking at swap dealers. And I have an issue with swap dealers, and I had an issue with swap dealers back in 2000, 2001, and 2002. Something was happening in the markets. Swap dealers started coming into derivatives, not just interest rates in foreign exchange, but all the markets, commodities, stock indices, everything. So what are we looking at? This comes from the Bank of International Settlements. And what is this? This is the amounts outstanding of over-the-counter derivatives. What does that mean? These are futures contracts. This is what big banks, or I should say the swap dealers, are doing. And yes, I just said it. They are the big banks. Total contracts here as of June 2014. Again, this is from the Bank of International Settlements. That's BIS.org. You can look this up yourself. That number is 691,492 billion, which means it's 691 trillion. This is the notional amounts outstanding. Foreign exchange, $74.7 trillion. Interest rates, which makes sense. Banks have been trading interest rates forever. That's 563.2 trillion. Here's your stock indices, 6.9 trillion. Commodity contracts, 2.2 trillion. And this is interesting. For all of you who are wondering why gold's not trading at $5,000 an ounce, like everyone was telling us back in the gold rush, check out this. In 2 years, from June 2012, notional amounts dropped from $523 billion in just gold. These are trillions. This is $70 trillion, $65 trillion. Again, this is notional value. This happens to come from the comptroller of the currency here in the U.S. They track this stuff. Now keep in mind, of these 25 banks, you're looking at 238.9 trillion. But most of it, 90% of it, is controlled by your top 4 banks. And it's interesting here. Goldman Sachs has total assets of $111 billion, but they're number 3. Interesting. And if you want to track this, think about it. How do we track how big money is posturing in any market? Here we go. In 1962, the CFTC came out with a Commitments of Traders report in 1962. And it was the same report all the way until 2009, after an awful lot of people were complaining about the old COT report, including myself. And yes, I was calling the Chicago offices of the CFTC to make those complaints. The old report in 1962 was what we call the legacy report. This broke down commercials, non-commercials, which were large speculators, and non-reportables. I don't report my positions. Many of you might. I don't. However, commercials, and this is interesting, were not held to position limits. That's because they were in the business of handling the commodity, bringing you cornflakes in the morning. Non-commercials were held to position limits. Their sole purpose for being there was for speculation. So what happened in 2009? In 2009, the CFTC came out with the disaggregated report. That's for commodities. This is taking all that big money we saw, the swap dealers, and pulling them out of the commercial category where they were in before. And because they were in the commercial category, they were not held to position limits. And of course, many of you may have heard in the news that that's exactly what they're trying to do today, is they're trying to give swap dealers position limits. So the correlation to the legacy report and the disaggregated report in 2009 was the commercials from the legacy was split into producers and swap dealers. Producers being the true commercials. Those are the guys who bring cornflakes to your breakfast table, or orange juice to your breakfast table, or coffee to your breakfast table, or meat to your dinner table, like steak, beef. Producers and swap dealers, when you put those numbers together, that's the commercials. Large spec was split from the legacy report into managed money and other reportables. A year later, about a year later, in 2010, traders and financial futures, dealer intermediaries are defined by the CFTC as the big banks. They're also defined, and listen to this, as the sell side of the market, as defined. When you're a sell side of the market, you're selling as the market's going up. Those are the guys in the pits that are selling as price action's heading to the sky. The buy side at the CFTC, asset managers and leverage funds and other reportables. Other reportables in both groups are big enough that they have to report the positions, but they don't fit in any other category other than other reportables. So you're probably wondering, how do you use this to make money? Well, let's have a look. How to analyze and make money using the COT. The COT data is best analyzed when graphed as a net position on a weekly price chart. On a weekly price chart, not a daily chart, not a monthly chart, on a weekly chart. Because knowing a simple net position is meaningless, as it must be compared with recent historical levels in a respective market. And the relative bullishness or bearishness of the commercial net position is easier seen when you view the current net position with the highest and lowest net position over a select period of time. I created something at Trends and Futures called the Commercial Tracker, and I created that about 15 years ago. It looks at the old legacy report, the commercials, and tracks this for a year. It's all color-coded and everything, telling you when things are taking place, if you're at a 52-week high or 52-week low. But when the new reports came out, those are the reports I look at today. I analyze these every day at Trends and Futures. So, we have the why. Fundamentals. Fundamentals it's why the markets move. And I don't care what market you're looking at. Again, I'm talking about futures now, not individual stocks. We have the what moves the markets. We know buying and selling moves the markets. And we know how to track that using the Commitment to Traders report. So, we have to go to now when. When is it time for you to enter a market? And that's where technicals come in. Technicals, they give you the ability for timing when a move may be underway. They provide us the reason to enter and exit a market. That's it. And believe me when I tell you, when I was at Futures Magazine Group, managing Futures Learning Center, a lot of the editors wanted me to review software or books. It was the software that used to drive me a little bit crazy. Why? Not to pick out any software, but Metastock was given to me in 1998. And I installed it in my computer, and I was going through it, and I realized they had 141 technical indicators to choose from. And my head almost blew up. Coming off the floor, I was like, what is this? No one on the floor knew what I was talking about when I brought it up. So, using technicals, what do you want to be able to do? Well, for me, I look at 8 different market conditions. And this is all the markets, basically. You've got a weak trending market that's weakening. You've got a weak trending market that's strengthening. Both of these market conditions, price action is in a range. You look for that range. You should have a strong uptrend starting. That market's rising. The price action is rising. And that could start within a range. And when you get a breakout of that range, usually it's a good breakout. Strong downtrends starting, market's dropping. It's the same thing as a strong uptrend starting. This market starts dropping within a range. That breakout of that range, if you can confirm it's a strong downtrend starting, looks to be a good breakout. If it's a weak trending market and you've got a breakout out of a range, realize that might not be a good breakout. Be very careful. Strong uptrend strengthening. Price action's rising. This is where you want to be in a trade. Actually, you want to catch it as the uptrend's starting. And I'll show you exactly how to do that in a moment. Now, you have a strong uptrend weakening. What's happening? The market's dropping. And more dangerous is the price action gets choppy here. Strong uptrend strengthening, price action is dropping. And a strong downtrend weakening. Again, price action starts rising, and the price action gets choppy. You've got to be very careful in these market conditions. So how do you define all these market conditions with one strategy? Well, let's find out. First, a successful trading strategy must quickly tell you a few things. First, strength or weakness of trend. Second, if buyers or sellers are in control. Third, if a market is overbought or oversold, with the connection to strength of trend. That's important. And momentum of current price action. And of course, a successful trading strategy must also tell you exactly how big money is moving in the market you are trading. So, what we're going to have a look at right now is a look at my MTS Trading Strategy. And the first thing I'm going to be looking at is a primary indicator that I think everyone should be using when they're trading. It's the only indicator I'm going to cover today, but I do have other indicators on the charts that I use, and I'm going to show you those on the charts when I show you the charts. But a look at my MTS Trading Strategy, as I mentioned, my primary indicator, or my favorite indicator, is ADX. And it's part of the directional movement system. And at Trends and Futures, we use a modified ADX. It's a little bit different. However, why do I like ADX? The sole reason ADX exists is to measure strength of trend. That is it. It doesn't tell me market direction. If I see ADX numbers at 30 or 40, I know it's a strong trending market. However, I do not know what direction that market's moving in. What helps me there is the Directional Movement Index, which is part of the Directional Movement System. DI plus measures strength of buyers. DI minus measures strength of sellers. Now, the rules of ADX are simple. Again, measuring trend strength. It does not tell you anything about market direction. ADX value for me, 0 to 20, no trend or weak trend. I call these weak trending markets. I even call markets that are under 25 weak trending, but 20 to 25, you can say is a transition area, whether it's rising up in 20 to 25 or coming down. 25 to 40 for me, anything over 25, I will call a strong trending market at Trends and Futures. At 40 to 60, very strong trending market. At 60 plus, that's an extreme trending market. Many times, when ADX numbers hit 40, 45, 50, many times you see a correction, not a trend change, just a slight correction down before the market continues its trend. It's not always. It's just sometimes. So that's the rules of ADX. What about the rules of DMI, or Directional Movement Index? Well, here we have DI plus crossing over DI minus. And what I call DI differential, which is the distance between DI plus and DI minus, is rising. This is where buyers are taking control. DI minus is over DI plus. and the differential is rising, this is where sellers are taking control. What do you think is going to happen to a market when buyers are taking control and ADX numbers are coming up? Let's have a look. Here, we're putting it all together now. A cross up over 25 and rising, that ADX number, and DI plus is over DI minus and DI differential is rising. Time to look for a long position in the market you're looking at. We have a cross up over 25 and rising. And DI minus is over DI plus and DI differential is rising. It's time to look for a shorting opportunity in the market you're looking at. Here we have ADX numbers above 40 and dropping. This is where we have DI plus over DI minus and DI differential is dropping. If you're long the market, which you would be if you're using trends and futures, where I do also cover Forex, you're looking to possibly exit the market or adjust your stops accordingly. ADX numbers above 40 and dropping, where DI minus is over DI plus and DI differential is dropping. You're in a short position, or you would be if you're using trends and futures, looking for a possible exit or tightening up your stops. One of the most important things at trends and futures, where I do cover, as I mentioned, futures and Forex, is I teach people, I show people, I actually force people, learn how to pocket money when you're trading. It's the most important thing you could learn. You've got to learn how to pocket money. So, MTS Trading Strategy on a daily chart. On a daily chart, I use candlesticks for many different reasons. One of the most important reasons is candlesticks give me the ability to very quickly see the relationship between the open and the close. There's also things like dojis I look at, and when they're there, it's good to see them there when something's taking place. I do not, and I do not use candlesticks alone. On the daily chart, I have a 4, 8, and 18-day exponential moving average. I have ADX, a 14-day modified ADX. We have a 14-period DI plus and a 14-period DI minus. Stochastics, 14-period. And MACD is there as a secondary indicator. And it's a 12, 26, and 9. And that's on a daily chart. And if you're position trading any of these markets and not day trading, you also need to look at weekly charts. And on a weekly chart, what am I looking at? On a weekly chart, MTS strategy, a little bit different. I have candlesticks, but I have a 10-period and 20-period exponential moving average. ADX is dropped. ADX numbers are dropped. The modified ADX is a 10. DI plus and DI minus is a 10. And stochastics you could change to 10 or 12 or 14. That's up to you. I'll use 14 or 10, depending on what market I'm looking at. And of course, the most important thing for me in trading futures or Forex on a weekly chart is the commitments of traders reports. And I show them both. I show the legacy report and a disaggregated report in commodity futures. And in financial futures, I also use the legacy report and the traders in financial futures, the one that looks at the S&P, T-bonds, and currencies. And that's the one you want to look at if you're trading Forex. And speaking of Forex, let's have a look at some charts. Now, over to the left, we've got a daily chart of the US dollar index. This is the June 2015 futures contract. On the right, we've got a weekly chart. And let's see if I could use a drawing tool here. Really clearly, you could see, as I mentioned, about DI plus and DI minus. DI plus right out here is crossing over DI minus. And ADX numbers start coming up, showing you it's time to look for a long opportunity in the US dollar index. And as I mentioned to the members of Trends and Futures, how about just over 90? Look at 90 back in here, right here. Catching a really nice move up, right in here. The market gets into a range, right in here. As what's taking place? ADX numbers are dropping, and the market becomes a weak trending market to once again break out at the top of the range here. And what's happening? ADX numbers start coming up. You're long above 96. If you're long above 90, customers are adding to their net longs. And then, look at the large drop on March 18th. What was happening here? The Fed spoke. Janet Yellen was speaking. Look at the range here, all the way down here. Is that a fundamental? I guess so. Well, look at the dollar weakness down to 97, and then dollar strength. What's happening today? What is happening right now today as we speak? The U.S. dollar is coming down from 100. It was a weak trending market getting into overbought territory. You can see that right in here. ADX numbers are at 23.4. It's a weak trending market. There was some signs of strength developing to this move up. But once it became overbought, the market's going to drop. Technically, this is on technicals now. If it's a weak trending market in overbought condition, technically you've got to watch for the correction down. And if we see that drop take place, there's a good chance we're going to retest 97. If not a retest, if the price action gets back below 97, the U.S. dollar might continue to drop. However, let's not forget about the weekly chart here. On a weekly chart, here we have a green MTS. On a weekly chart, yes, this is working on a weekly chart, MTS. ADX numbers start coming up. DI plus over DI minus. DI differential is increasing, but what's also taking place? Uh-oh, the market's in overbought territory. On a weekly chart, it could stay there for a while. Why? Strong trending market. More importantly, what is causing this move? Right in here. Increased buying and selling by dealer intermediaries, adding to their net shorts. This is bullish. Remember what I said. Dealer intermediaries are the sell side of the market, defined by, not by me, by the CFTC. And look at this bullish posturing right in here. It doesn't get any better than this. Look how long the market was overbought for. On a weekly chart, ADX numbers are still high, but they're dropping, showing signs of weakness coming to the U.S. dollar. I do not trade off a weekly chart. If I'm position trading these markets, I'm trading off a daily chart. And if I'm day trading, I'm not using the weekly chart at all. And I do day trade 4 different markets. So that's the U.S. dollar. And you can see very clearly here how you would have caught some really nice moves up. I tell Trends and Futures members these areas every day. Now on the opposite side of this, how about the euro? And think about this. Think about this really. If you're trading the U.S. dollar, if you're trading the euro-U.S. dollar forex pair, this is important, especially looking at big money in the euro. What do we have taking place up here? A red MTS signal right in here. What's happening? Once again, we see a strong trending market down. We saw this taking place in July 2014 as the price action was coming down from 138 at Trends and Futures with Trend Trader's help. The CRB Trend Trader is the service that gives us specific recommendations. It shorted the euro in July and held on, rolling over the entire time. It also did that in the Euro-US dollar Forex pair. However, if you're looking to get in and get out and take profits, here's your move down, right in here. Right there. Strong trending market down that started weakening as the price action got into a range. I tell my members, always adjust your stops if you're position trading on the largest open trade equity close, right in here. If you get stopped out, you look to re-enter the market. If you don't get stopped out, which you would not have been stopped out here with using my exit strategy, you have a red MTS signal right here. It takes patience to see this, but when this is taking place, think about the markets you catch and the moves you catch. Weakening trending market. What's happening right now in the euro? It's a weak trending market. We see signs of strength developing from this move down. What we need to see now is a break below 106. However, weak trending market. Technically, you got to watch for the correction up. Why? It's an oversold territory. And I do believe the market has come up. And I do believe, the market's coming up today. The dollar's been down today pretty hard. So we see a correction taking place from oversold condition in a range. How do I know the market's in a range? Confirmation of this range is quite simple. It's a weak trending market. Now, more importantly, on a weekly chart, remember what I said about July? Red MTS trigger right there on a break below 136. However, we saw a red MTS trigger right in here. You started seeing strength of trend develop. It slowed down right in here. However, on a weekly chart, stochastics were correcting out of overbought territory. And just like the US dollar being overbought, look at the euro being oversold. And that's okay. It becomes a strong trending market down. And big money here. If you didn't see this taking place, I hate to say this, if you don't see this happening, this would not be taking place. Think about this. As I mentioned, the CFTC defines dealer intermediaries as the sell side of the market. Well, what happens when they become the buy side of the market? The market starts coming down. And you see little areas here of bullish posturing for a short period of time. Brings the price action up. So now, today, as of today, this past week, we did see a bear move in the COT. Also, I highlight this every week at Trends and Futures. So that's the euro. And one other market, or one other currency I love to look at when it comes to big money is the Japanese yen. Why is that? What's amazing to me here is right here. This red MTS and this drop down. What was happening? We see dealer intermediaries dropping net shorts, becoming net long, right before somebody won the election, Abe. And when Abe was running, his platform was to drop the yen. And the dealer intermediaries helped him do just that. And the yen came down. Look how long dealer intermediaries have been net long the yen. And when they get stronger in this posture, look what happens to the yen. And today, you see what's happening. A bullish posture is taking place as dealer intermediaries are liquidating their net longs. If they become net short and leverage funds becomes net long, and they start adding to those, the Japanese yen is going to go up. And I'm expecting that to take place. Why? A comment made yesterday by an Abe, someone that works for Abe. I guess he's an assistant of his. He made a comment yesterday, or an advisor. I think he's an advisor of Abe. He made a comment yesterday that the drop in the yen is approaching its limit, and that might just be 82. Look at 82 here on a weekly chart. So if you watch this week to week, watch what happens. And I have a couple questions here that I want to just quickly grab before they go up the screen. The markets I day trade are the E-mini S&P, gold, crude oil, and soybeans. Those are the only 4 markets I look at throughout the day. That's it. And that's because, for me, they give me a pretty good bang for the buck. I like the way beans move. I love the way crude oil moves. And gold's been kind of crazy in the last few days, or actually the last few months. But I like the way they move. And the other markets I do trade, and I do position trade these markets. I love position trading softs and the grains, corn, wheat, especially when I use what I use, MTS. And watch the posture of how big money's posturing. If you trade options on any of these markets and you're not looking at the COT, you're doing yourself a disservice. Watching how big money's posturing in a market is going to give you an idea of where the market's headed, just like the fundamental. So what about commodities? Well, here's crude oil. I don't know if any of you are trading commodities, but if you are looking to learn how to trade, use trends and futures. I'll teach you everything I know about trading these markets. And in crude oil, we all know what's been taking place. Hopefully, we all know what's been taking place. What's been happening in crude oil recently is the drop to 44. And an awful lot of people are saying they called this the low. Look at 46 back in here. But what is most important here is what's been happening with the strength of trend. Strength of trend weakened. This became a weak trending market. Again, we had signs of strength develop to move down here to hit 44. But now we've got a green MTS signal right in here. As DI plus crossed over DI minus, but what was happening? ADX numbers are still dropping. And stochastics right now are actually up on the price action over the last few days. What's happening on a weekly chart is interesting. This is very interesting. First of all, we had a red MTS signal on a weekly chart all the way out here. As the price action came down below 105, then you're looking at a possible short below 100. Is what takes place. The differential increases. ADX numbers start coming up. Why not get on for the ride? Stochastics are correcting from overbought territory. See that here. And what about big money? Here's something that's very interesting. Swap dealers back in here are not speculating crude oil. They're hedging crude oil. And they're long. They're short. They're net short right out here. They're the strong sell side of crude. Back when crude oil traded at $110 a barrel, they were the only group net short. Even producers, which is not normal here at all, were net long. Right up here. Producers, other reportables, and managed money were net long. That's just not right, as far as I'm concerned. Producers are supposed to be the side that sells because they're hedging crude oil. This group here, swap dealers, they're hedging crude oil now. And what takes place when they start liquidating? Look at the price of crude oil. Now, and this is something I was waiting for when this was getting close. I was waiting for the cross of producers crossing down below swap dealers, and that's taking place. Producers are adding to net shorts. Swap dealers are adding to net shorts. And managed money's adding to net longs. This is a bullish posture by big money. If this continues week after week, crude oil prices will continue to go up. And I do believe in the June contract, if we get a solid close over 56, the next stop, as long as I see big money adding to a bullish posture, will be $60 a barrel. That's in the June contract. This happens to be the May contract. And Shane, you're asking the question that almost everybody asks. The same question I used to ask when I was on the floor. That guy who's selling right now, he's got to be losing money. He's selling in the market and it's going up. What's he doing screaming sell, sell, sell? They're hedgers. They're making money on a different side of the market. They own the cash commodity. And they're doing this in futures. So when they're done, they can liquidate and bring the price back to where they can get out. So dealers are not losing money the whole time here. These are futures contracts that they'll hold on to for a length of time. In crude oil, they can go out as far as they want. But believe me, JP Morgan Chase is not losing money shorting out here. As a matter of fact, why they're hedging crude oil might have more to do with something like USO, like an ETF in crude, that they can't hedge their long-only positions, but they can do that with swap dealers. Just like in gold and GLD. GLD owns a large warehouse of gold. They're not allowed to trade futures or hedge that gold position they have because they're selling that. They're selling the ETF. You own 1/10 of an ounce of gold. That gold that's held there, they can't hedge, but they can do that in the swaps market. How do I know that? Right above slow stochastic is MACD. MACD I use as a confirmation indicator to show me divergence, whether or not we have momentum in a market or the price action itself. And it's a secondary indicator I use. It just keeps me more balanced than not using it at all on a daily chart. If you notice, I don't use it on a weekly chart. Now, speaking of gold, and I'm not sure of how many of you trade gold. You might trade GLD. That's okay. It's the same thing. You got currently ADX numbers, 19.5. It's a weak trending market. Oh, I'm sorry. I have a question here from, okay, I guess you all can see this. Above the slow stochastic on the weekly chart, that's the disaggregated report of the commitment of traders report. Just above that is the old legacy report. There's a correlation there. Why do I have so many? The indicators I present, ADX and stochastics are completely correlated. What I mean by that is this. When you have a weak trending market, an oversold condition, I know it's not going to remain there very long. It's just not, it's not going to happen. Just like we see in gold right now. Gold, you look at gold right now. You see right here, it's a weak trending market, an overbought condition. I know it's not going to remain there very long, and it didn't. It corrected out of this area here on a bounce down from 1220, right in here. It's a weak trending market. If you got a strong trending market, like we see up here, the market could be oversold for a month or two even. But you can see very clearly here, right on TS, price action comes down nicely here. Is what's happening. DI minus crosses up over DI plus. Strength of trend. Strength of trend. Is the market's coming up. Know the strength of trend. I have not found any indicator that does that as well as ADX. I've tried an awful lot of them. ADX tells you that one thing that I really don't see any other indicator telling me, specifically strength of trend. In gold, ADX numbers on a weekly chart are 23.5. It's a weak trending market. Just like on the daily chart, oversold condition. It's not going to remain there very long, and it doesn't. Oversold, correction. Daily chart, overbought, correction. And what about big money in gold? How is big money posturing? Well, here we go. Swap dealers are actually hedging gold. And I think it's for the same reasons as I mentioned as crude oil. GLD hires swap dealers to do just that. And when they're adding to net shorts, like producers, the price action in gold comes up. This is on a weekly chart, remember. Correction down from 1300. Gold would have never made it to 1300 without this. And then the selling takes place, or the liquidation, I should say. They're liquidating. Open interest is dropping. Producers and swap dealers are getting out of their net shorts. And managed money is liquidating net longs. And the price comes down. Now, over the past few weeks, like all the trends and futures members know, we had a bullish posturing taking place. Right in here. That's a bullish move for the last few weeks. And price action is coming up. Now, when you say so many indicators, I'm just curious to know, I could drop MACD off of this and do the same thing. I use MACD mainly for some of the customers too, also at Trends and Futures. A lot of people like seeing MACD there for some reason. I really don't need to. I do have the Commitment of Traders report for both for the purposes of teaching people how to use the COT more than anything else. Again, I don't really need to see this report here, the legacy report. The more transparent report is the new reports. It shows you exactly what big money is doing in the market. And that just, it doesn't mean, again, too, understand this, just because there's a bullish posture in the market, it doesn't mean the market can't come down for a day or two, or even a week. A lot of things take place, like Janet Yellen speaking, or something else. Now, we've taken a look at currencies, crude oil, and we've taken a look at gold. What about for, say, we look at corn, and we trade corn at Trends and Futures, a lot of corn. Now in corn, and I covered this today, at Trends and Futures when I do my trader updates, I covered corn. Corn, we're looking at a lot of fundamentals today. Why? We're planting today. The U.S. is planting the corn crop. We've had a lot of reports come out over the last few weeks. Actually, one report that came out really crushed corn prices right in here. What was that? That's a report, the grain stocks report, showed we have an awful lot of grain here in the U.S., corn specifically. And we also saw a report that came out that showed how much acreage we're going to be planting this year. A drop of 2%, which is not that much. I was expecting a bigger drop because of where corn prices are today. But that didn't happen. And keep in mind, I don't trade on what I think. It's a very difficult thing to do, I know. I never trade on what I think. I trade on only what I see. So looking at ADX in corn, ADX numbers are coming up, 25. We're just starting to see a strong trending market develop from the move down here. However, oversold condition. And what happens? We see a correction up. It has to do with where we are today. 25.3 is not just a strong trending market up. In deep oversold condition, technically you got to watch for the correction up, especially looking at where the price action is. Look at that right here. The last time the market was trading at 370, price action came up. Now in corn, weekly chart, here you can clearly see how big money affects the price of corn. So what's happening here? Well, for one thing, swap dealers have a large net long position in corn. Why are they net long corn? That's what they do in corn. Were they in corn before 1999? No, but they're there today, and they have to be dealt with. However, what I'm looking at here is manage money and the relationship to producers. That's how you see the posture. The old report, you had commercials and large spec. And the drop right here. What do we see taking place? You seriously think you couldn't short the market below 480 and hold on for the ride? And then, bullish posturing again. And now, the market, ADX numbers on a weekly chart, 26.5. We still have a little range here. And what am I looking for? I'm looking for a bullish posture by big money. And week after week, I'll be referring to what we call crop progress here in grains. It's important to look at. You see what's going on with plantings, and as the soybeans go into the ground in a few more weeks, we watch that. Now, I know many of you might not trade commodities like grains, but it's important to understand what's happening in the grain markets fundamentally. So this is corn. And after corn, we'll have a quick look at the Dow. Here's the Dow. And the Dow is in a range. It's a weak trending market. 17,500. Secondary maybe bottom of the range, 17,600. But check it out. 18,000, definitely the top of the range. I'll give maybe a secondary top to 18,100. But you could see this market's in a range, and confirmation of that is it's a weak trending market. And stochastics have now entered overbought territory. Watch for the correction down from 18. I do believe today, market's up a bit, but watch the price action at 18,000. Technically, you got to watch for the correction down. If something happens fundamentally, like positive earnings come out, we might see the Dow break 18,000. Whether or not it breaks 18,100, we'll have to wait and see. On a weekly chart, though, yes, big money is involved in this market also. What do we see taking place? It's a weak trending market on a weekly chart, confirming our weekly range here, right in here. You see how low ADX numbers are here? Stochastics on a weekly chart did correct out of overbought territory, but are once again turned up. And big money this past week, slight bull move. And what was a bearish posture? See that right in here. What I would prefer seeing is a bullish move right now, or a couple weeks of bullish moves, to confirm a move over 18,000. I don't think we're gonna see that. Again, I don't trade what I think. I only trade what I see. And what I see right now, technically in the Dow, is we could be in store for a nice correction down, at least to 17,006 or 17,005. A break below this, we'll be going on to 17,000. And it won't be a bad thing. We've had a 1,000-point move here, and a bigger one here. And the world didn't come to an end. Even in 2011, when we had a 2,000-point drop, the world didn't come to an end. So that's the Dow. And this works the same way in the even the S&P or NASDAQ, the Russell, if you trade that. Not to leave you, anyone trading Forex out there, this is the Euro Japanese yen. I could have used the US dollar Japanese yen, but I wanted to use two currencies that are not actually attached to the US dollar. The Euro Japanese yen. Works the same way. Now here, I'm not looking at a weekly chart because there's no COT, but you could look at the COT report on the futures contracts to see how big money's posturing in the euro or the Japanese yen. The euro-Japanese yen, you have a weakening trending market. And you have a situation here with a red MTS signal. But you have a weakening trending market. What you're looking for then is a shorting opportunity to come up right in here. As ADX numbers start coming up, and DI plus starts moving away from DI, DI minus starts moving away from DI plus. Right in here, catching a nice move down. Again, adjusting your stops on the largest open trade equity close. If you get stopped out, you watch the market come up, green MTS, weakening trending market. What's weakening? The strong trending market down. Then we got a strong trending market down here off a red MTS signal right in here. And what are you waiting for? You can short the market below 134 if you're really conservative, below 132 and take a small profit right in here. And then you got again, a weakening trending market here. And then look at this move right here. These are short-term moves, but you could take some money off the table over a few days. So that's the euro-Japanese yen forex pair. Now, for all of you who are day traders, who are intraday traders, I trade intraday, just those four markets I mentioned. I position trade everything else. I don't trade that many markets at a time, though. When I'm position trading, I might only be in positions maybe in 4 markets, 5 markets tops. I don't like to overtrade. That gets me in a lot of trouble. Believe me, I've done it before. The 5-minute chart trading strategy. Now, I have a complete video on day trading at Trends and Futures. On this 5-minute chart trading strategy, I have candlesticks, exponential moving averages, 1020, ADX. I do not place stochastics on a daily chart. If you want to do that, that's up to you. I play with it sometimes. I don't necessarily use that, but I only have these 3 things on a 5-minute chart that I'm looking at to trade the markets. And it's the same thing. I'm only looking to catch intraday trends. I'm not looking to catch the next bar up or down. I'm only looking to catch a nice move up for, say, 6, 7, 8, 10 bars or longer, and that's what I'm looking to do. And with this, I'm only looking at possibly making 3 to 4, maybe 3 trades in, say, the E-mini S&P, or 2 trades in E-mini S&P, depending on what's happening in the market. Now, if you want to really quickly understand the COT better and understand how to use the Commitment of Traders report in your trading, I have a book. I just finished a new release of this book, and you're more than welcome to come and actually send me an email. Send me an email at gary@trendsandfutures.com. I will email you that book for free. It's an ebook on how to use the COT to trade. Yes, you can go to the cftc.gov website and check out the COT report there, but that's not charting. You're not getting it on a chart where you need to look at it. That's just looking at numbers. The numbers are very impressive to look at, especially because when you see how many traders are in each category. That's amazing. But the CFTC, the COT report, has to be looked at a weekly chart over a number of years. So for me, if you want, again, email me at gary@trendsandfutures.com, and I'll send you the book free of charge. Just if you want, just put COT book in the subject line, and I'll just reply to your email. Now, for me, successful trading is not easy, but it does not have to be complicated. Remember, I was traded, for me, trading was introduced to me on the floor, and the best advice I got when I started trading was to trade for beer money. So a trading strategy that identifies trades with the highest probability of success for all market conditions. That's what I'll show you at Trends and Futures. It's the one strategy that I use that works in all market conditions. People that try to sell you 10 different market strategies are doing just that. They're selling you something. And two, proper trade management until exit, maximizing winners and minimizing losers. What I do with trends and futures is quite simple. I teach you my exit strategy. Actually, I have a video. Everything I do with trends and futures is on video. I have what I call my ultimate exit strategy, and it's really not, there's no such thing as that. I just use it as a name. But it's really about, there's no correct place to get out of a trade. When you're managing money in a trade, that's when you have to learn how to accept what you're going to take out of that trade. If you're going to give back some or get out a little bit too soon, I always give back on a trade. A little bit, 20% maybe. And that's what I teach at Trends and Futures. So Trends and Futures, you'll get a trading strategy that will build your confidence and discipline. Without building your confidence in what you're doing, you won't develop discipline. I see an awful lot of people advertising how to be disciplined, but if you're not confident in the approach you're using that helps you make money, you're not going to be disciplined to follow those rules or follow your trading strategy. You're going to bounce around from trading strategy to trading strategy. It's not going to get you disciplined. A flexible, accurate strategy, again, that works in all market conditions. And what you get at Trends and Futures are tools to execute the strategy from entry to exit. All futures and Forex trade recommendations that come from the CRB, Trend Trader, which has been around since 1963. And with all those trade recommendations, you get my personal guidance on videos every day. So at Trends and Futures, if you want, you're more than welcome to take a 14-day trial. There's a URL right there. I don't think you can click on that, but if somebody, can someone type this in? I'm not sure if someone who's listening to this on at Cyber Trading University, they can type that URL into the general chat line. Can someone just type that in? I'm not sure who can do that. But if you have that free 14-day trial, it is 100% free. If you want a couple of things, I've had a few questions about the success at Trends and Futures or the success of the CRB Trend Trader. If you would like, I have a 6.5-year spreadsheet of all the trade recommendations in the history of the Trend Trader trades. If you want me to send you that spreadsheet, email me. Just email me history of TT and the subject line or something like that, and I'll be happy to send you an email back, reply to you. If you want to call me, I'm a real person. I take people's phone calls. And if you want to follow me on Twitter, you can follow me on Twitter at Trends and Futures. But more importantly, what I want you to do is really get a fix on how markets are moving today. You know, why they move, what's moving them, and when do you get in? And at this point, if anyone has any questions that you want to ask, go ahead and ask. If you have any questions afterwards, feel free to give me a holler at my phone number, again, 312-506-8706. And if, again, you want to really learn how to make money and pocket money in these markets, try the 14-day free trial. You really have nothing to lose. And we'll talk on the phone on all 14-day trials that come from Cyber Trading University. Well, I do give away a 20-minute coaching session with me on the phone. And we can go through charts. We can go through anything you want to go through, markets, charts. I just need to let you know, I do not trade individual stocks. I trade futures contracts, and I do trade Forex. So if there aren't any questions or additional questions, let's see here. Any additional questions here? No. Oh, here they come. Hold on a second. No, great question, Shane. That's a great question. Back in the, I don't want to say back in the old days because I don't want to age myself, but back in the day, everyone used to look at, try to say which group do you follow? Or what, you said you feel more or less give, I don't give, I look at all the groups combined. Now I do look at swap dealers just because they're there, but the relationship between producers, say, and managed money is possibly more important. The fact that the big money's there is just there. I don't think they're going away anytime soon. So I mean, with regard to that, it's really about watching the group as a whole and see how they kind of move away from each other and come back. Basically bullish and bearish posturing as a group. When swap dealers go long market, when swap dealers, again, when swap dealers go long a market, they're there for a reason. Depending on if you're looking at, say, crude oil or if you're looking at grains. Grains, they're speculating, in crude oil, they're hedging. I wouldn't follow swap dealers necessarily because they have an awful lot of money, as I showed you earlier in this in this webinar. But when swap dealers do go long a market, many times the price action is coming down. They're buying when the action is price action is low. That's what they're doing. As you'll see, when price action comes up, they're kind of out there by themselves, doing their own thing, not in a relationship with producers or the managed money. But they used to be put into commercials, which was a very serious problem for some of us who used to use commercials. When commercials were, they just didn't look right in 2004. In 2006, I was like, this doesn't make any sense the way commercials are posturing today. It didn't, because swap dealers were included in the commercial category. Can you spell the indicator again by stochastic? Is this on the weekly chart? If you're looking on the weekly chart, that's the commitment of traders report, either the traders in financial futures for financial futures or the disaggregated report. Disaggregated, D-I-S-A-G-G-R-A-G-E-T-E-D, disaggregated report. Okay, here, can you please describe how, well, for me, when I come in the morning here down in Chicago, about 6 a.m., all my markets are up that I day trade, and I look at the price action overnight. Very quickly, I look at the price action overnight. There's actually a tool at Trends and Futures that you'll see if you take a 14-day trial. It's called the Futures and, well, one's the Future Strategizer, one's the Forex Strategizer. Everything I told you about MTS, you could take a look at all the markets and in 3 minutes know what's going on in 47 commodity markets, 20 Forex pairs, and 23 ETFs. The ETFs we cover are basically commodity ETFs, like USO or GLD. But when you look at the Future Strategizer and the Forex Strategizer, in 3 minutes, I could tell you on 47 futures markets, the strength of trend, overbought oversold condition. I can tell you just about anything you want to know about the market. I don't like to look at charts all night long for 30 charts. I want to look at the markets that I need to be looking at on the chart. The Futures and Forex Strategizer, when you see them, you'll know exactly what I'm talking about. It'll tell you exactly what the market's doing. The way I present the charts at the COT at Trends and Futures, I don't know many people who do both, but yeah, you could look at the COT at Trends and Futures, and one of the biggest things you want to do, of course, is when you're looking at the COT on a weekly chart, plot ADX and plot a stochastic. Their relationship works. I do have a question here about studying Elliott wave. Bob Prechter's a good friend. I don't know if you know who Bob Prechter is. He's probably one of the oldest Elliott wave technicians out there. He used to come into my offices at Futures Magazine. Years ago, his daughter went to Northwestern University here in Evanston, Illinois, and we're in Chicago. And he'd come in and we talk, and he showed me a lot on Elliott wave. I don't know many people from the floor who ever used Elliott wave. I do understand from what he was showing me, but the problem with, at the time, Bob Prechter was always telling me back in 97, 98, that the stock market was going to crash. And he kept on telling me that Every time I saw him, stock market's going to crash, stock market's going to crash, He told me that for 3 years before the market actually did come down. And he used to come in and tell me, when it did happen, he called me and told me, see, I told you this is going to happen. And I said, Bob, you told me that 3 years ago. If I followed your advice 3 years ago, I would have lost money. It's all about timing. And Bob does tell you what he thinks, just so you know. Thanks, Mark. I appreciate those comments. But in reality, for me and all the members of Trends and Futures, they all know this. I really want people to make money trading. I really want people to make money using the service. And I've had talked to people. I've actually given people. I've had people use the service for a while. They're not getting it, or something's wrong. They're not trading right. I'll spend time with them on the phone. I'll make sure that I give them every opportunity to make money trading. Again, it's not something that's hard. It's not complicated. It shouldn't be a complicated thing. One strategy that works in all market conditions. If that strategy puts money in your pocket, you'll develop confidence in that strategy, and you follow those rules. Again, coming off the floor, I knew guys on the floor for 20, 30 years. They did the same thing every day. They didn't make changes to what they do every day. They got on the floor, and they whatever they had to do, they adjusted. They were flexible enough to adjust to market conditions, but they used their same strategy day in and day out. And believe me when I tell you, I never met more characters in my entire life than on the floor of the board of trade. So if there aren't any more questions, again, if you want to see a history of the Trend Trader trades at CRB for the last 6.5 years, email me at gary@trendsandfutures.com. If you want my free ebook on the COT and exactly how to use the COT, send me an email at gary@trendsandfutures.com. You can call me if you like. And make sure you follow me on Twitter. I do put things on Twitter every week. Actually, every day, too. But the weekly stuff I put on Twitter has to do with the COT and what I think about what's going on in the COT. So again, I want to thank everyone for spending time with me today in Mastering Market Direction. I hope today's information helps put more money in your pocket. After all, that's the goal. And how I enter a trade bi-weekly. I do enter trades on a daily basis, meaning that if I want to get into a trade on a position trade, it's a daily chart. If it's on I enter trades on a real-time chart, off a 5-minute chart, and I look at my real-time to get into the trades. A 5-minute chart tells me when to get in and when to look to get in. And just so you all know, all my videos end with one thing. The most important thing is for everybody here, you need to be well. Then you can trade well and follow the trends. Thanks for having me.